The equity markets are officially closed right now as it is early Friday morning on July 10th, 2026, which means we must look directly at the official closing figures from the most recent trading session on Thursday, July 9th, 2026 to understand where things stand. At the final bell, Datavault AI Inc., trading under the ticker symbol DVLT on the NASDAQ Capital Market, finished the day at exactly $0.3776 per share. This represents a solid intraday upward move of 6.04%, climbing $0.0215 from the previous close. While a move of 2 cents might sound minuscule to someone who only tracks massive corporate giants like Apple stock, for a microcap company with hundreds of millions of shares outstanding, a 6% single-day move signals a notable shift in market sentiment. This gain also tells us that the stock is attempting to stabilize after experiencing intense volatility over the past several weeks, drawing significant attention across various digital circles. The immediate surprise here that completely flips standard expectations upside down is that this sudden burst of momentum is not driven by simple retail speculation or random internet hype. Instead, it traces back to a major institutional milestone that caught almost everyone off guard. On July 1, 2026, the United States Patent and Trademark Office issued a notice of allowance for a highly specialized patent application filed by Datavault AI. This specific legal framework covers a proprietary system for tokenized dividend distribution, designed to track down, expose, and significantly reduce naked or excessive short selling across public markets. When a small company manages to secure 24 separate claims in a single patent allowance within less than 6 months of filing, it fundamentally shifts how institutional players view the firm. It transforms the asset from a speculative tech microcap into a serious holder of core financial market infrastructure intellectual property. The general consensus across mainstream investing sites, public forums, and retail platforms like the Robinhood app has long been that Datavault AI is a risky, ultra-volatile penny stock best left to hyper-aggressive day trading. Most casual market participants who engage in online investing assume that companies trading under $1 are structural traps with no tangible underlying value. This view is completely understandable given the historical performance of the asset, which has hovered near its 52-week low of $0.2512 and remains far below its 52-week high of $4.10. The contrarian take, however, forces us to look past the current sub-dollar stock price and examine what this new technological foundation actually does. By creating digital dividend tokens for verified shareholders on a distributed ledger, Datavault AI is building a mechanism that can automatically cross-reference actual distributed shares against the positions reported by traditional financial intermediaries. This means if a brokerage firm or institutional short seller has created synthetic or uncovered positions, the platform can block their dividend entitlement and force an automatic recall of lent shares through smart contracts. When you look at how people manage their wealth today, whether they are using automated systems like Schwab Intelligent Portfolios or taking a hands-on approach through self-investing, there is a massive structural demand for transparency. A modern individual brokerage account gives everyday people access to global markets, but those retail accounts are frequently vulnerable to the hidden liquidity dynamics of institutional shorting. Traders on an advanced interactive broker's trading setup often see the effects of this hidden supply, even if they do not see the back-office mechanisms causing it. By embedding share verification directly into dividend delivery, this small firm is tackling a structural issue that has frustrated public companies for decades. For investors who look for specialized investment help or browse major online investment platforms trying to find asymmetrical opportunities, this shift from a simple technology provider to a regulatory infrastructure player changes the calculation entirely. The recent trading behavior of this asset highlights the intense tug-of-war between short-term liquidations and long-term accumulation. Back on July 1st, when the patent news initially broke, the market exploded with unprecedented volume, seeing over 105 million shares change hands in a single session, driving the price up by over 15%. But as is typical with small-cap equities, that massive spike was met with heavy institutional profit-taking and programmatic selling on active trading desks, pulling the stock back down toward the mid-30-cent range. The fact that the stock bounced back up by over 6% on July 9th shows that buyers are stepping back in to build support above the 35-cent mark. Institutional ownership currently sits around 35%, while mutual funds and equity-traded funds hold a little under 3%. The remaining 62% is held by public companies and retail investors using platforms ranging from traditional firms like Fidelity Investments to modern active choices like SoFi Invest. To properly analyze where this business is going, we need to understand exactly what Datavault AI does and how its business model has shifted over time. The corporate entity we see today is actually the result of a massive operational pivot. The business was originally formed back in 2010 as Summit Semiconductor, focusing on wireless audio systems. It went public under that name in 2018, later rebranding to YSAW Wireless Technologies and eventually becoming YSAW Technologies in 2022. The major turning point occurred at the end of 2024 when the company completed an asset purchase from a privately held group called Datavault Holdings, leading to the official name change to Datavault AI Inc. in February 2025. Today, the business operates by applying artificial intelligence to extract data, which it then tokenizes on blockchain ledgers to ensure security, identity verification, and data monetization. This model spans multiple sectors, including financial technology, marketing data compliance, identity verification, and biomedical research data tracking. Financially, the company is operating under an aggressive expansion framework that carries significant risk but also substantial projected scale. In its first quarter financial reports for 2026, the company reported a net loss per share of minus $0.09, which actually beat the consensus expectation of minus $0.14. More importantly, the company reported initial quarterly revenue of $3.42 million, while boldly reaffirming its full-year guidance of $200 million. Management has made it clear that their revenue generation is heavily weighted toward the second half of the year, dependent on major commercial rollouts and partnership execution. To fund these massive scale-up efforts, the firm maintains roughly $250 million in liquidity, with about $140 million in clean working capital following a series of private equity placements. This capital runway gives them the ability to pursue strategic growth without facing an immediate cash crunch, though the dilutive impact of those past capital raises is exactly why the stock is trading where it is today. A core component of their midterm growth strategy is a definitive agreement to acquire an organization called NASDAQ, a blockchain-enabled financial advertising exchange that holds critical joint intellectual property agreements with NASDAQ itself. This acquisition is explicitly designed to merge NASDAQ's financial exchange infrastructure with Datavault's tokenization systems. This integration aligns directly with broader structural moves happening in Washington and New York. For instance, earlier this year, the Securities and Exchange Commission approved a series of rules allowing certain traditional securities to settle and trade in tokenized forms while maintaining their standard identification codes and investor rights. This means the regulatory landscape is gradually opening up to the exact infrastructure Datavault is trying to patent, creating a massive addressable market if their technology becomes an industry standard for mid-cap and small-cap companies looking to defend their share structures from predatory trading practices. However, the contrast between management's sky-high expectations and current market reality is where the real investment risk lives. Right now, retail traders using a mobile app to manage a basic individual brokerage account are looking at a company with a market capitalization of roughly $315 million that needs to go from $3 million in quarterly revenue to $200 million in full-year revenue in a matter of months. That's a monumentally steep hill to climb. Furthermore, the company's reliance on political and regulatory developments is intense. The management team has explicitly stated that their long-term monetization model heavily relies on the passage and implementation of pending federal legislation, specifically the Clarity Act, which governs digital asset frameworks and tokenized securities. If that legislation gets delayed in congressional committees or faces legal challenges, Datavault's commercial timeline could stall completely, leaving them with high operational cash burn and a declining capital runway. There's also the persistent overhang of legal and structural compliance that frequently plagues companies executing major corporate turnarounds. Just recently, prominent securities law firms, including the Pomerantz law firm, announced formal investigations into potential shareholder claims on behalf of investors, looking into whether the company misrepresented its commercial readiness